It's virtual and in person. It is an honor to welcome you to the Rise of the Short-Term Actuary Industry Update, hosted by ASABA and Old Mutual. My name is Panashe Akutangwi. I'm an academically qualified general insurance actuary at EY, and I'm here on behalf of, as a representative of the South African Black Actuarial Profession of South Africa, or ASABA, as the ASABA Head of Mentorship. This venture has been done before, but what it aims to do is to discuss industry topics and issues to assist those writing the short-term insurance examinations F103 and F203. For those not familiar with ASABA, our vision is to realize an actuarial profession that better represents the demographics of South Africa. ASABA currently does this through various initiatives and programs, such as vacation work, community outreach, the mentorship program, and the Actuarial Women's Committee. We are excited to be partnering with Old Mutual Insure on this initiative, as well as other initiatives, such as the networking event held earlier this year, the research prize to be awarded for those doing research in short-term insurance, as well as at a masterclass level. And we believe that through these events and initiatives, we can transform the short-term actuarial profession in South Africa. So our first topic of today is going to be contrasting IFRS 17 and SAM and the impact of IFRS 17 on SAM. Speaking on this is Karen Muyengwa, who is currently the head of actuarial control function team at Old Mutual Insure, holding a practicing certificate in short-term insurance. She's a qualified actuary with ASA with 7+ years of experience in the actuarial corporate environment. She has extensive experience in short-term insurance, from reserving, capital assessments, ORSA, and IFRS 17 implementation in South Africa and beyond. Please help me welcome Karen Muyengwa.
Thank you, Panashe. I'll just get the clicker on. Thanks. Thanks. Thank you, guys. So today's agenda is as you see, and we'll start on the first presentation, and later on Rowald to present on the impact of tax changes on SAM LACDT, and Ron, our chief actuary, will present on the rising rates and the impacts on short-term insurance. Cool. So for the agenda on contrasting IFRS 17 and SAM, we'll start off by just having an overview of IFRS 17. We don't have much time, so we're not going to cover everything. And then we'll also consider key changes to the liability, so particularly your liability for remaining coverage and your liability for incurred claims. And then in comparing these two, we'll discuss the contract boundary considerations, best estimate cash flows. Are those the same? Are they going to be different? Risk adjustment versus risk margin, discounting, and other items. And then finally, which is probably the biggest question for most of our industry colleagues, will IFRS 17 change SAM? Will technical provisions change? Will SAM, SCR change, etc.? And we'll just conclude with what I believe my opinion on what we should think about in the future. Cool. So IFRS 17 on a page. Yes, I did it. IFRS 17 on one page. First thing you need to consider is just the IFRS 17 classification. So there's that little box on section 1 in that one corner. The first thing you need to do is just to identify scope of your contracts as an insurance company. Do all your contracts fit into IFRS 17 definition? Do they have significant risk or not? And then the next step around that is to separate all combined components of contracts, separate out things that are distinct investment components or not, separate out things that are service components for disclosure purposes. It's also important for you to then assign your contracts to portfolios and then portfolio groups. I think they have three main buckets: what is profitable, what's onerous, and kind of a bucket in the middle. And then last but not least is to then determine just the recognition of your contract scope. When do you recognize a contract? When do you say a contract is starting and when is it actually ending? When you have done all of that, from just your understanding your products, you move on to measurement. How are you going to measure them? So you do need to consider the items in pink, which is, I think I moved one more slide there, which is measuring your cash flows as they come through from your contract. Measure your best estimate cash flows. Essentially, what do you owe as service or liabilities on your contracts? Consider time value of money, so you do need to discount your liabilities and add a risk adjustment. And also add CSM, but only if you're doing the liability for remaining coverage, because we are not releasing profits up front. But you won't have CSM if you're doing the liability for incurred claims. So the three basic models IFRS 17 talks to are as follows. There's the general model, which is that breakdown that I showed you there. And it is the default model. It's a discounted cash flow model with an allowance for risk due to uncertainty. There's also the VFA model, which works really well for most of the life, for some of the life contracts with discretionary participation features. And last but not least, but the short-term favorite, PAA, which is a simplified method that just essentially collapses all of those, I call it look through, where you can see every build up of your premium, but we just combine it all and look at premiums as we've always done, but netted off of your cash flows, your commissions and your premium debtors and things like that. Another area that IFRS 17 will impact is your presentation and disclosures. So there is a complete redesign required of your annual financial statements and disclosures. And this includes both your statement of financial position, so your balance sheet, and your income statement. So under your balance sheet, it's important that your insurance contract assets and insurance contract liabilities are disclosed separately. And this applies to your reinsurance contract. So we don't net things off anymore. We look at contract and say, is this an asset or is this a liability? So we no longer separate, oh, I've got a UPR, but they haven't paid me the money, and show them separately. You net it off together. And then moving on to the income statement, it's quite different from IFRS 4, what we've always been doing, particularly on the items 1, 2, and 3 there. Insurance service results. So we no longer have your claims and expenses section. We call it insurance service results, and your financial results and other operating results that do need to be separated. So IFRS 17 has rules around what goes into each section. For example, directly attributable expenses will be part of your insurance service results, and your non-attributable expenses will form part of your other operating results. And all insurers have to go through this, kind of look into all your expenses and all your outflows and make sure that they fall into the right bucket. Last but not least, there is a transition period. So IFRS 17 is live from January 2023. It's for all financial years that start from January 2023. So for example, all mutual insure with the year end of December 2023, it means our financials from this year have to be on IFRS 17 basis. The guys with the 1st of July financial start date literally gain 6 more months because it's their financial years that start this year going forward. But entities are required to create transition balance sheets for 2022 or the previous year, because you don't just show this year's financials, but you also have to show comparatives. So your previous financials also have to be on IFRS 17. So it's been a lot of work to have sign-offs from your audits or also your second line teams to sign off your transition balances, closing balances, and also, I mean, it's going to be a lot of work we know that's coming this year. So just moving on to the PAA, just to zone in and look into the simplification. This is how it looks like. But I just want to focus more on the box in the corner, because this is how you can really simplify it. In that it is your previous kind of UPR. I'm simplifying it a lot. Net of your DEC and net of your premium debtors and commission creditors. It's akin to that. But the full definition in the standard is what you see in the box on the left, essentially where your kind of closing balance for PA, LFRC, or liability for remaining coverage would be what you started off with, plus the premiums that you received in the period, less insurance acquisition cash flows. And I mean, insurers have to define what are their insurance acquisition cash flows, plus any amortization of acquisition cash flows. And this is, again, another policy choice that insurers have to determine whether do they want to amortize or not. And any adjustment to financing component. And this comes in when you've got contracts where you receive the premium upfront, but the cover is provided over a period longer than a year. So we will have some accretion of interest, for example, in contracts like extended motor warranty, which is something very different from how IFRS 4 used to be. We didn't have to accrete interest before, but there is an adjustment for financing longer than a year. Less your insurance revenue is recognized, is defined in paragraph B126, and you also have to deduct any investment components paid or transferred to the LIC. So that's kind of what is the PA LFRC in a nutshell. For liability for incurred claims, it's quite similar to what we've always been, I want to say always been used to, but of course, IFRS 17 is coming to change things for more clarity, essentially, because things have not always been the same. So if we move on to the next slide, really struggling with the pointer. What I have here is just on a snapshot, how do the two liabilities look? Above the line is where you have the liability for remaining coverage. So IFRS 4 was usually UPR less DAC. But what IFRS 17 is bringing, and you can measure this between two methods, PA or GMM. So maybe another question, when do you get to use PA? You get to use PA where your term of your contract is a year or less. You can use PA automatically, or you have to prove that the results under PAA do not significantly differ from the results that you get if you modeled them under GMM. So that's how you can use PA or not. So for GMM contracts, this is how the liability for remaining coverage would look like. You have to estimate best estimate cash flows, allow for time value of money, add a risk adjustment, and there's that CSM loading. But if it's PAA, it's akin to the IFRS 4 number, which is your premium less acquisition costs. So quite similar to what the previous slide said. On the liability for incurred claims, in the past, or IFRS 4, I think it's the definition under the standards and IFRS 4 is just hold sufficient reserves. And that's difficult for investors to know what's sufficient reserves. How do they compare Old Mutual to Holland or Actuarial, etc.? And they were usually undiscounted. So there was no time value of money, and there were different methodologies across the market and across the world, really. So this is coming to essentially, IFRS 17 is trying to bring more consistency across companies, and just more in terms of the disclosures that they can easily compare. So if you're modeling a leak, it's always done under using the general measurement model. There's no PAA approach for leak. You always have to do it, discounted cash flow model way. And you build it up, best estimate, allow for time value of money, and there's a risk adjustment. So you see that the leak component is the same, regardless of how you measured your liability for remaining coverage, which is your future risk. So how does this compare to SAM? So next slide, please. SAM, and I've tried to use similar colors and different colors intentionally. So if we start from the bottom on liability for incurred claims, best estimate cash flows in your leak is likely going to be the same. We would really not expect much differences there. discounting, SAM requires that you discount all your cash flows. And there is a prescribed risk-free rate structure that the PA provides every month. Whereas under LEAK, you have to essentially build up your yield curves as a company, and that can differ from the SAM curves, yield curves, essentially. SAM has what they call a risk margin, which is a cost of capital approach-driven number, essentially that you add to your liabilities, and this can be the same to your risk adjustment. Again, on risk adjustment methodologies, companies can use whatever they want. So it can be the same or it can be different. Then if we move on to the liability for remaining coverage, SAM requires that you discount your future liabilities to say, what do I owe my policyholders? So you're not allowed to actually hold margins or profit loadings that sit in your UPR. You have to release those ones up front. So that's from a visual perspective how these two buckets in terms of IFRS 17 and SAM between liability for remaining coverage and liability for incurred claims look. Cool. So continuing on this journey to contrasting the two, so just move on. If we just discuss contract boundaries. So both standards talk to contract boundaries, and IFRS 17, and I'll just read it roughly what it says. So contract boundary essentially, maybe before I do that, essentially it's important for us to understand the contract boundary for our contracts. So that you know when your contracts are starting and what cash flows where you're going to actually end. So under IFRS 17, cash flows are within the boundary of an insurance contract if they arise from substantive rights and obligations that exist during the reporting period in which the entity can compel the policyholder to pay the premiums, or in which the entity has substantive obligation to provide the policyholder with insurance contract services. So I actually just took a snippet. There's further conditions that regarding when the substantive obligation actually ends, and they really talk to the ability to reprice. And there's also discussions around this: when do you have practical ability and when do you have legal ability? So there's discussions or gray areas around that. But that's sort of what IFRS 17 speaks to. It speaks to the practical ability to reprice. Whereas SAM, on the other hand, I think it's got a little bit more conditions. It actually includes in Part A the ability to, or the unilateral right to terminate an insurance contract. So SAM is quite explicit in that you can allow for when you can cancel a contract, whereas IFRS 17 is saying when are you able to reprice a contract, which are slightly different, I think. On SAM, you need to consider, the contract boundary is when you have the unilateral right to terminate the contract, reject the premiums payable under the insurance contract, or when you have the right to amend the premiums on or the benefits payable under the contract. So in terms of considerations, given these two definitions, what can we draw from this? Firstly, in my view, should mostly be the same for most of South Africa's short-term insurance contracts. A monthly contract is a monthly contract between the two. And under both bases, we wouldn't be allowing for any future contracts really. But in some instances, because the same definition is explicitly allowing for termination of contract, it's likely to have a shorter boundary for some products, whereas under 17, you may actually push it out, because if you haven't necessarily done, it's unlikely that you just cancel your whole book. If you really want to consider when are you able to reprice, you might extend that more. For example, annual contracts that are payable monthly. Maybe you may have a clause that you'll cancel contracts with 30-day notice, but if you're really not able to, you might want to extend that boundary. But it does depend on your policy wordings and something that your company will need to go into more detail. Moving on to the next slide, considering best estimate cash flows. I think I've spoken to this one already. They are really quite similar. I've got the definitions there from the standards, but where does it impact? So IFRS 17, it will really impact when you're doing your loss component projections. So loss component is a term we use for the additional liability that you have to add to your current, I want to say UPR or LFRC, when you've got what we call onerous contracts. So if you are aware that I've got a loss-making contract and the premiums we've charged now are not sufficient to cover future claims and expenses, you have to essentially add these additional liabilities. So say you've got a contract and the premium is 100 Rand and that's what you have at the moment, and you've written this contract, but the combined ratio is say 120%, you'd have to hold that additional 20. So you're essentially, in terms of how you project what is best estimate, this is essentially this projections and determining what is that 20 if it's best estimate. This is where the definition of best estimate cash flows will essentially come in. Best estimate cash flows will also impact your claim provision. So in your leak, and this way has to be done both on your gross and your reinsurance results. On SAM, we mentioned best estimate when we're determining your premium provisions. They have to be done on a best estimate basis, also on your claims provisions, so both gross and RI. So in short, we expect on an undiscounted basis, if we don't discount this result, we expect this to be the same. Although if you've got any contract boundary differences, it may cause differences. Cool, moving on to the next one. Risk adjustment versus risk margin. Walt also alluded to some of the points already, and those are the definitions. But IFRS 17 in summary, we want essentially a loading or an estimate that reflects the compensation the entity requires for bearing the uncertainty about the amount and timing of the cash flows that arises from non-financial risk. So IFRS 17 speaks to non-financial risk, and there's an additional requirement that you should disclose the confidence level used. So it won't say each company has to make a policy choice how much risk adjustment they want to hold. It's up to them, like whether it's 75th or 65th or 90th percentile, it's up to them. SAM is quite explicit. You have to hold a cost of capital approach based margin. And essentially the risk margin is the part of technical provisions in addition to the best estimate liability to ensure that the value of your technical provisions is equivalent to the amount that insurers would expect to charge to take over the insurance liability. So I want compensation for holding your liabilities. What is the cost of capital for the capital that I'm holding to hold your liabilities? So some considerations, there's diversification, or you have to allow for some correlation by risk types. And I'm only speaking to this on the IFRS 17 side, but SAM is quite explicit on how you should calculate it. There's also different approaches that can be considered under IFRS 17. You can use cost of capital approach or quantum methodologies. For example, just like bootstrapping and creating your percentile distributions and then choosing a point. There's also time horizon considerations. Do you want to hold margins for, perhaps being wrong or uncertainty, for the uncertainty over the next year or until ultimate? Also, in general, there needs to be some alignment between what the reserving team is doing and capital teams is doing, as well as just your current processes. Most people are just rolling forward what they're currently doing, but I guess IFRS 17 does give that opportunity to revamp and relook and decide as management what you want to do. So therefore, in summary, as actuaries, we need to assess the practicality, cost, and effort associated with the selected method that you're going to choose. Are you able to maintain it going forward? Are you able to explain it to management and your board, essentially? And I think there's actually quite some rules that your risk adjustment needs to abide to from the standard itself. So moving on to the next slide. So on discounting, so IFRS 17 does say you need to allow for time value of money. But if I move on to the second bullet point under IFRS 17, if you are applying PAA, the entity is not required to adjust your future cash flows for the time value of money if those cash flows are expected to be paid or received in 1 year or less. So there's this additional simplification if you're using PA, that you don't have to discount cash flows that happen in a year or less. But under SAM, in contrast, you discount everything, even if you're paying it tomorrow. Well, maybe next month, at least. Another difference is just around yield curves. So IFRS 17 says yield curves should be determined by the entity, and the discount rate should reflect characteristics of the cash flows and liquidity characteristics of the insurance contract and be consistent with observable current market practices. So there's quite a long list of things to tick. And also, last but not least, there's that interest accretion component that we spoke to already, where your premium is upfront, but your term is longer than a year. Under SAM, we don't have this accretion component. So there's some similarities, but not really. And what we are finding, and what I'm like to stress, it is quite important for insurance companies to really manage their asset liability matching for IFRS 17 reporting. I think Ron will add to it later in his presentation. And last but not least, under IFRS 17, you also need to consider if you want to add any liquidity risk premium on top of your risk premium. But it does depend on the assets you are invested in that are backing your liabilities. And also consider how you're constructing the yield curve. There's like top-down and bottom-up approaches. So the yield curve, in summary, that you use on IFRS 17 can differ from SAM. But for short-term companies, because we generally invest in short-dated assets, whether it's bonds or mostly cash, it should be the same. Cool. Next slide. So just some other, and I'm trying to really summarize given that I don't have much time. Profit recognition. IFRS 17 is saying essentially earn your premium according to passage of time. So essentially uniformly, as we've always done for most risks, but it's quite explicit. If your expected pattern of release of risk during the coverage period differs significantly from the passage of time. So if we know, for example, engineering contracts, the risk increases as your project goes over time, you must use a pattern that mimics that, model it for that. So this is just around how do you earn your premium and how do you essentially using based on the risk. Whereas SAM, we can't talk about how we earn the premium because all profits must be released upfront. So there is no earnings, if I can put it that way, over time. And then another consideration under disclosures, IFRS 17 requires that you essentially present those liabilities, the LFRC and the LEAC, on a portfolio basis. You also, so portfolio is essentially business that is similar in risk and managed together. So you do need to do that kind of assessment. You also need to disclose your risk adjustment confidence level and methodology, and need to also present your liability for incurred claims, past and current service. To essentially say, for my LIC, what is, so say it's for 2022, what is stemming from 2021 and prior, and what's stemming from 2022. For SAM, we have to present all results by same line of business, and this is disclosed in your quantitative return templates, as well as aligned to the Insurance Act of South Africa. Last but not least is just the treatment of expenses. So IFRS 17 requires you to split your expenses between what you believe is directly attributable. So this essentially is talking to the fact that, you know, if you're looking at a contract, what expenses do you need to fulfill this contract? So you can exclude, maybe it's like random training or random team building, expenses or flights to Cape Town for, just some things that are not needed to fulfill the contract, and then you're non-attributable. And also it gives, entities options to amortize costs or not. And last but not least, there's just some considerations you need to do around your ULAE definition in your LEAC. Should you consider it directly attributable or take everything, essentially? For me, it's like a gray area, still sorting out. And then for SAM, it's cash flow based. So you have to release any DEC asset. If you've paid for it, it's in the past, you don't allow for it now. And I want to say, my opinion, I think the expenses treatments under SAM is quite more clear. And there's also a little bit of guidance on it in guidance notes for FSI 2.2. The next slide. So now that we have kind of compared the two on a very high level, what is the actual impact of IFRS 17 on SAM? So next slide. We're going to go through this column by column. So we'll start by your technical provisions. So on your TPs, not much changes on your claims, but I think on your, when I say premium provisions, the standard reference is UPR, right? But IFRS 17 doesn't have the term UPR at all. We call it liability for remaining coverage, which nets off your cash flows as we discussed, etc. So the UPR term does not exist on IFRS 17. LFRC includes cash flow impact and interest accretion, whether using PAA or GMM, depending also on the term of your contract. And earnings patterns may have changed. So that's a big impact, that this UPR or LFRC component is also being impacted by changes in earnings patterns. You may have to have added additional liabilities because you've loss-making contracts or onerous contracts, and you need to have added also a risk adjustment on that. So all of this is kind of changing what we've always known as UPR. But what is there a big impact on it or not? So in my opinion, ideally should not, because we're really using the same definition now. SAM wants you to have the discounted cash flow of your future liabilities. It doesn't say you should net off any cash flows. But perhaps also as insurers have been going through the journey, they've had to refine their methodologies, and as they've been getting more data and more understanding, so there might be some changes. But maybe then begs the question, should we be tracking some of the IFRS 4 items that we're used to? And then who's going to audit those components? So in the future, we're only going to audit LFRC. Will we have to have maybe audited UPR amounts? Perhaps it will be done through the SAM audit, that are your inputs aligned to SAM? Are your inputs aligned to what the true number is on your financial, from your systems essentially? But perhaps it's just additional work, additional expenses, because you know it's a little bit more work. It's not like referencing an already audited number under IFRS 4, because it's something that's not featuring anymore. Cool. And if we now move on to SCR, so this is like a big one. You know, I guess at the end of the day, SAM is the capital. So there's multiple references to earned premium, written premium, and net earned premium. And these components will really no longer exist under IFRS 17. I know we've been really focusing a lot on balance sheet items, but then these components which stem from your income statement will be replaced by what we're going to call insurance revenue, which is similar to earned premium. So it's quite similar, but there can be differences because of those unbundling of service components, or also interest accretion can impact your insurance revenue as well. So whether using PA or GMM, the way the CSM unwinds and the way the discounting unwinds can literally impact your top line. And also if considerations need to be made for loss components. And when we talk about net earned premium, I mean, there's no net line anymore in our financials. We just have the gross, you know, insurance revenue, your insurance service results, and then you've got your RI revenue, you know, expenses and income, which can be netted off as well. So it's important to also consider how it's going to impact your RI, you know, is this net of commission or not? So things are not looking the same as they used to before. And this can impact essentially your MCR, whether it's, you know, in your MCR calculation, you consider technical provisions or premiums. So depending on which one is biting, can change your MCR results. Premium risk, where we look at earned premium over the past 12 months or the next 12 months, etc. Method 1, catch risk for liability and trade credit, where premium is used. Method 2, catch risk in its entirety because premium is used. So those are kind of the areas where premium is referenced, and it's not necessarily super clear what insurers should be using now. But maybe to just summarize and conclude on this one, the current shock parameters, big assumption that they are really, I think, dependent on previous kind of IFRS 4 volume measures. So to really change these volume measures and replace them with IFRS 17 might not be the right thing to do. So ideally, you should not change this until perhaps the PA does provide some guidance. Or so essentially, maybe as companies, we need to kind of still have a good handle of what our earned premium is, what's our written premium. I think it's something business should always be tracking anyway to understand their sales and if they're growing or not. And maybe could we avoid all this and just have SAM around actuarial estimates of what earned premium is? And also maybe to avoid all this is just have your own internal model. I mean, it's a big deal. Or maybe replace the parameters so that you can model them internally as a company and do what you believe is right. Hold your own economic capital. Next slide. These are the last three components. On LACDT, because we tend to project future profits and see if, post an event post a shock event equal to your SCR base number, how much loss absorbing capacity deferred taxes can you hold? So most of the business plans are now going to be on IFRS 17 basis, so they would really change your future profits. And because your profits are changing, your deferred tax assets and liabilities are changing. And this is really assuming that the tax basis remains the same. And by that, I mean, will SARS change how they'll tax companies because IFRS 17 is coming into play or not? So all in all, there will be some LACDT change, but this also depends how your IFRS 17 income statement compares to your IFRS 4 income statement from a bottom line perspective. So likely to change, but again, really expected to be minimal for short-term insurance. Own funds, because our IFRS net asset value is changing, your retained earnings. When you move from IFRS to SAM, you either gain or lose. Essentially, you either make profits or make losses, and then you raise deferred tax liability or asset. And then again, assuming tax bases remain the same. So because your starting position of IFRS has changed, you expect an own funds change, but should be minimal for short-term insurance. And then last but not least, disclosures. So the quantitative return template. So for anyone writing, I really suggest that you have a look at the SAM reporting template. There's quite a number of tabs, but the key ones in my view, the one on your balance sheets and income statements, where the, for example, in income statements, there's lines on earned premium, written premium, commissions, which is different from what IFRS 17 looks like. So perhaps those tabs do need to be restated because we now have a new standard. And there's just a general financial impact because all those numbers may have changed. So maybe we need new templates, we'll see, or we need to still maintain IFRS 4 kind of income statement and balance sheets. And again, having this different set of financials would mean another audit level and might be expensive to maintain, really. Cool, so to conclude, in summary, expect minimal financial impact for short-term insurer, but there are some cosmetics. Your income statement is changing, your balance sheet is changing. Ideally, you as a company want to merge your processes and calculations where the two standards converge. For example, on your claim provisions, because it's still just your claims, it's still your OCR, your IBNR, nothing of that sort has really changed. And it's always good to compare the two bases, understand the differences, document your methodologies and assumptions, particularly where they differ, explain and or train your board to appreciate the differences without expecting to be the same, or just even how SAM is changing, if at all. And it's important to also then consider your operational impact to maintain all these bases, IFRS 4, IFRS 17, and SAM. I think that's it from me. Thank you. I took longer than I needed. Was having fun. Cool. I'll take any questions from the floor or online.
Hi, Corin. Thank you so much for that. Just from a lowly pricing actuary who has very little to know about these subjects, how do they coincide? So where does IFRS 4, SAM, and IFRS 17 meet? Do they go hand in hand? Are we moving from one to another?
Oh, yes, I needed to take a step back. So we've got IFRS is our International Financial Reporting Standards. So we've got financials for what is published to say how much, what's our income statement, what's our balance sheet. So that's just submitted. For example, we are listed, so I guess that those packs go out to market to just know how much money did Old Mutual make, whatever. SAM is a requirement by the Prudential Authority, which is a regulatory basis. So these two are serving two different things. So IFRS 17 is a new standard replacing IFRS 4 for the way we publish our financial statements. Whereas SAM, which is a revamp from it's been in effect since 2018, is for your regulatory capital basis, where you calculate your capital. Are you solvent? Are you in line with what the regulators say you should do? So in the future, it would just be IFRS 17 for published basis and SAM for regulatory purposes.
Okay, thank you.
Cool. The question online. So
The question from Johan. He says, if you have a monthly contract, but a cash back payable in say 5 years time, what is your contract boundary under IFRS 17 legally? 1 month, that's a question mark. Practically,
yes. So I think it's been a contentious issue. I think there's many psycho papers on it, but in a nutshell, I think I would say go and look at the definition of liability for incurred claim in the IFRS 17 standards. And there's a part B there that just says, allow for any liabilities that have not been considered elsewhere. So what South Africa has practically done is to model cashbacks as part of liability for incurred claim. And it doesn't change what we've always done. It doesn't make, just to also get away from having the boundary being 5 years or 3 years, just model, if somebody stays on your book for 1 month, you now owe them 10% of the premium they paid, but you still pay it in 3 years' time or 2 years' time, depending on where they are on that cashback lifetime. And kind of in summary, I would say most of South Africa has just gone with liability of incurred claims, but it does depend on your policy wording. There's certain wording where you might be stuck with actually modeling cashbacks as part of your 3-year kind of liability for remaining coverage. But because of that catch-all, that's my 2 cents on it, that you can actually model it there. Yeah, go ahead.
If the PA were considering changing the QRT theoretically, which tabs would you expect to change, and should that precede or follow the considerations on capital exposure measure or volume measures?
So I've already highlighted some of the tabs that I expect to change. So anything that has balance sheets and income statement measures on premium, commissions, everything there. But on terms of capital, I think you said volume measures. I mean, things like some insureds, they don't feature on financial statements. So those will remain the same, where you do your method 1 and CAT, and you've got some insureds by Cresta Zone and product, essentially. So those won't really change. Yeah, but we're yet to see if they will really change the template. I think I would really say take the QRT and wherever you see an income statement balance sheet with it. I mean, I've really summarized it, but the QRT is going to detail for like your gross liabilities, RL liabilities, foreign liabilities. So it's like the same thing multiple times, but really balance sheet and income statement is the nutshell. Oh, I think that's it. Thank you, guys. I'll hand over to Panashe. Thank you.
Thank you. That's working. Yep, it's working fine. Thank you, Karen. We really appreciate that, especially given that IFRS 17 is very confusing to almost everyone in the insurance industry at the moment. Our next topic is going to be the impact of tax changes on the SAM LACDT. Speaking on this topic is Ronald van der Walt, who is an academically qualified actuary with ASABA. Rowald has over 5 years working experience and joined OMI in 2022 from Guardrisk. His areas of expertise include reserving, SAM, also reporting, IFRS 17 automation, cell captive insurance, budgets and capital management models. So please give a round of applause for Rowald.
Yes, sorry, can you guys hear me? Okay, 100%. Okay, everybody, very late, good afternoon or maybe a good evening. My name is Rowald, as introduced, and today I want to talk a little bit about the changes recently introduced from a tax point of view, as well as also brush up a little bit on LACDT, or what we call the loss absorbing capacity of deferred taxes in SAM. So on the agenda today, we'll quickly introduce the scope of this presentation and also make high-level references to some material and resources available in the market out there. Then we'll quickly dive into a little bit of an overview on taxation applied in both SAM and on our IFRS basis, and how all of these components ultimately influence your LACDT in a stressed 1 in 200-year event. These kind of scenarios will play out over 3 illustrative examples. And then for item number 4 on the agenda, we actually get to the meat of the conversation, where we'll introduce the changes recently brought on in the Tax Lab Amendment Bill, and also do a broad-based impact assessment on the average general insurer in South Africa. As a final item or 2, we will discuss a couple of closing remarks and also have a question and answer session. Next slide, please. So in terms of the scope of this presentation, I think it's important to note that this is not intended to be any prescribed requirements or guidance, but you can use this presentation and some of the key takeaways that we give in this presentation as guidance to, number 1, navigate the complexities in the LACDT calculation in SAM, and also to interpret or to use our interpretation as a guidance in your business of the recent tax changes. Following on that, it's also important that the basis for the LACDT discussion is a standard formula basis, so not an economic or internal model view. We also use IFRS 4 as our accounting basis. And then very importantly, this is all in a South African environment or jurisdiction. In other words, the local regulatory regimes apply and also local taxation laws. Then maybe the final point in that scope session is also very important. Most times are spent by capital actuaries doing something what's called profit projections, which is a very important component improving recoverability in your LACDT calculation in SAM. We will make frequent reference to this or these profit projections or your ensuing profit projections. However, we will not dive into the detail and the underlying mechanics and subjective assumptions and a lot of complexities that these projections really involve in reality. Then in terms of references, there's really some nice references also on this topic in the market. The first one being a guidance note from ASAD himself. It's a comprehensive note. It really speaks to both non-life and life insurance. And it takes the LACDT component from the ground up with various considerations. There's also recently Deloitte South Africa launched a paper. This speaks more to different interpretations in SAM. So various non-life and life insurers interpret the guidance in the FSIs and the applications of these requirements differently, and they kind of brush up a little bit of what that can typically mean for insurers and what the financial rand and cent impact is on your capital numbers. And then finally, when we get to the taxation and changes in taxation component, we will be using a tax consultancy, PKF South Africa's kind of resources on a blog to illustrate some of the examples of how these changes can potentially play out. Next slide, please. So let's get to the interesting stuff. In terms of a quick overview of taxation for both IFRS and the SAM world, I would like to kind of use these 3 buckets. And these buckets will also, in a consistent chronologically manner, flow into the illustrative examples that follow soon. If some of these concepts do feel a little bit strange for you and you feel you need clarity, bear with me. I think some of the illustrative examples will really try and open up the concepts here. So in the first bucket is what we will refer to in this presentation as your on-balance sheet deferred tax asset or deferred tax liability. In other words, the DTA or DTL on-balance sheet. This is the IFRS basis, and for non-life insurers, this taxation is paid on an IFRS basis. In other words, our fiscal basis is IFRS as well. And this is all governed in Section 28 of the Income Tax Act. Maybe just to quickly hit home with a quick example of what a DTA or DTL really is on balance sheet. If I'm a non-life insurer and I make R100 profit, we assume a corporate tax rate is 27%, then I'm due to owe SARS R27, right? If I don't pay that money up front directly, I would need to raise a deferred tax liability to SARS. Vice versa, if I make R100 loss, I can raise a deferred tax asset, but very importantly, SARS won't pay me R27. We can use that asset to offset future obligations to SARS. So basically utilize your on-balance sheet deferred tax asset. So that's the basics of your IFRS position. Then very importantly, and Karen mentioned this in her discussion now, there's what's called a regulatory basis in South Africa, and that is SAM. And SAM is basically shifting. So you shift your basis from an IFRS balance sheet and an IFRS view to a SAM view or SAM balance sheet best estimate view. And as part of this basis shift, we also need to take into account what happens with our taxation obligations, right? So the second bucket is what we call the base adjusted deferred tax asset or deferred tax liability. And just a quick reference, for example, most typical non-life insurers will make increased profits as you release some of your profits upfront in your premium provision side, or on a claim provision side, you typically shift from a 75th percentile in a non-life environment to a best estimate environment. And all of this results in profit being released, on average speaking, in the South African market. And obviously then you need to pay tax on those profits. And then finally, once we've landed up at the best estimate balance sheet view, the whole purpose of SAM is to determine some capital, right, to protect your policyholders in an adverse 1 in 200-year event. And that adverse event is a loss, an instantaneous loss that you, as an insurer, suffer. And then the same principle apply. When you suffer this hypothetical loss, you will be able, and it's a massive loss, right? You will be able to raise a deferred tax asset. And that deferred tax asset that you raise can, in one ways and shapes and form, basically offset your capital requirement. However, and that is defined in FSI 4 Attachment 5. There's some rules and prescriptions or the definition of the LACDT and SAM governs how much you can raise and how much benefit you can take from a LACDT side of the view. So maybe let's quickly just run into FSI Attachment 5, if you don't mind. Next slide, please. I'm not going to dive, as you guys can see, it is a chunky formula. There's a lot of information there, and I think at first glance, it is quite technical. And you need to spend a little bit of time to really appreciate all of the complexities built into that formula. Just a quick couple of points that we can point out is that the loss that you basically suffer instantaneously in your stress scenario is described as the SUR shock rather, sorry. And that is just an aggregation function of your basic solvency capital requirement, your operational risk, and your participation risk if you have any insurance participations on your book. I think I would like to stand still on item number 3 as well. This is a really important item, and it speaks to the component that I've mentioned in the scope of this presentation. So there's a part where once you've basically suffered this loss and you want to raise a deferred tax asset, you need to do profit projections post your stress to prove that you can, in a reasonable scenario, recover within 3 years the tax asset that you want to raise. And that's basically the concept of proving recoverability. And item number 3 is stating that you can only reasonably raise a deferred tax asset to the maximum of the concept that you've proved recoverability, or sorry, the minimum to the concept that you've proved recoverability or the deferred tax asset. So I know this might still feel not intuitive for you or for some of the audience members that haven't worked in capital. And I think going on to the first illustrative example, we'll unpack that, but keep that number or that caveat in the back of your mind. It is an important consideration when we get to the tax implications later in this presentation. So in terms of this busy slide, the illustrative example, maybe just another caveat or two up front before we dive into this. There are some strong assumptions embedded in this. This is really just only for illustrative purposes and shouldn't be taken with a black and white view. This is how we should model it in practice. In practice, this calculation and various moving parts tend to become exponentially more difficult and more complex, right? So also the black horizontal lines is kind of the different steps or those buckets which I introduced a couple of slides ago in the calculation, and in a chronological fashion, we'll work through this. So as a starting point from a disclosure point of view, we say we have an IFRS net asset value, in other words, assets minus liabilities, broadly speaking, of 15 million. And then we say we also start from a disclosure point of view with a IFRS deferred tax asset position of 1 million. In other words, in past, we made a couple of losses and we still have a taxation assets which we can utilize in the future. Now, as part of our basis shift in step 2, we are basically saying from a SAM balance sheet best estimate point of view, we end up with 17 million assets minus liabilities. In other words, there's a 2 million profit from the 15 to the 17. That 2 million profit will have a tax implication, right? The tax rate is 27%. So obviously the additional tax then on those profits is 0.54. And then ultimately, and this is where the strong assumptions come in, but just bear with it. So now we net off is that we are saying we start off with a deferred tax asset position on IFRS. We make more profits on SAM, therefore we need to pay some taxes. So ideally, we end up with a best estimate base adjusted deferred tax asset position, which is lower than the 1. It's the 1 minus the 0.54, ending up at the 0.46. So that is our best estimate SAM taxation position. Now, when we step into the whole SAM environment, where we've calculated the shock and the instantaneous loss, item number 9, in this example is 10 million. Item number 10 and 11, I really want to also stand still on a little bit. Let's start off with item number 11. So we've suffered a loss of 10 million now, but now we can basically go with an argument and say, okay, we'll be able to raise a deferred tax asset, right? If we apply 27% to the 10 million, we end up with 2.7. The caveat in your FSI definition is that you need to prove recoverability on that. You can't just raise the full amount. And that's where item number 10 comes in. And just a final time iterating this is probably where a lot of the capital actuaries' time is spent to actually do your business plan projections, income statement, balance sheet projections, make assumptions in a post 1 in 200 year stress scenario, how an insurer would operate, what management actions can be triggered. And basically what this calculation, or in this illustrative example, we've ended up saying we'll make profits post 3 years, but the taxation on those profits will only be 2.5 million. So therefore, item number 12, and also speaking to the third point in the definition in the FSI, is capping it to the minimum of those two amounts. So your LACDT, or your stressed or maximum LACDT that you can raise, is only 2.5. And now the final piece of the puzzle, and how we end up with item number 13 and 15 being the same, your LACDT or adjustment factor, is we are saying, listen, on a SAM balance sheet, we already have a DTA position of 0.46. We can maximum only raise 2.5. So 2.5 minus the 0.46 end up being the 2.04, and that's your LACDT in SAM. So hopefully this first example kind of, I want to say, simplified some of these concepts. If not, there's another 2 examples which we will quickly glance over as well. Next slide, please. So from a second example point of view, it's pretty much the same. So we'll quickly read through this one. You still have an IFRS deferred tax asset position, but now in your basis shift. So just to quickly point out, moving from the IFRS to SAM, we make a loss. And there are some instances in which an insurer can make a loss in a basis shift. And then the taxation, obviously, on that loss is the item down there once again. And now note, once again, making assumptions, netting these two, adding together, we end up with a base adjusted DTA of 1.81. The section 3 or step 3 is exactly the same. So not going to go into this scenario. I really want to just stand still on item number 13. So you have an instantaneous loss. Theoretically, you can raise that amount. We proved recoverability only of that amount. And therefore, that's the maximum DTA we can raise in our stressed event. And now the final step, once again, is just saying we already have that in our base adjusted DTA position, the 1.81. So realistically, we can only raise a LACDT of the difference between the 2.5 and the 1.81, ending up at the 0.69. So this is a second example. I guess what we try to illustrate in this example is that depending on where you start from an IFRS position, how you shift basis, you can actually end up getting a bigger, lesser effect of LACDT in the SAM world, right? So there's a lot of moving parts which ultimately drive this number. The final example, just next slide, please. The final example just builds up from another point of view. So hopefully this is your typical balance sheet as an insurer. So we didn't previously made a lot of losses. You actually have profits made and you have a DTL. And now in a IFRS world or basis shift world, we also make additional profits. And we end up, seeing this kind of play out the following way. So there's, similar to the first scenario, a little bit of the taxation on the profits and your base adjusted DTL ending up at 1.54. Maybe one final point to mention here, this scenario can play out differently depending on what bite year, and then we can start having interesting conversations. Should we add or subtract or net off and gain additional LACDT benefits based on your DTL? For the purpose of this presentation, we won't go into that detail. So let's just quickly run through the final mechanics here. It's still your recoverability component, which is capping your LACDT, and assuming not the same source in this scenario, we are basically just saying that your LACDT benefit is the full amount that you can raise to 2.5 million. So that basically summarize the kind of, I want to say, complexities, just starting from your IFRS balance sheet, moving to basis or shifting basis, and then ending up assessing how your stress scenario would impact your LACDT together with your business plan projections. So hopefully this sets a decent foundation for what we actually want to discuss today. And those are the changes. Next slide, please. Those are the changes that was introduced. A little bit of context on these changes. The finance minister announced in the 2022 budget speech that there will be a little bit of a change in taxation for non-life insurers. This will be effective 31 March 2023 onwards. And to really drive home what this change actually is and to quickly unpack this last bullet in more detail, we'll take a minute or two. So in the past, companies were in most instances able to utilize 100% of the assessed losses. So in other words, you were able to utilize 100% of your DTA on balance sheet. So if you started making a profit, but you had a deferred tax asset, if your taxation on those profits were lower than your DTA, you could have offset it, and we'll do a couple of examples in a moment. However, the new kind of litigation is saying the amendment will limit the utilization of assessed losses, in other words, the utilization of your deferred tax asset to the higher of $1 million or 80% of your taxable income. Next slide, please. So to quickly drive home with a couple of examples, just what this means, and once again, this is taken from PKF's website. There was a blog that they've written basically with these various exact examples that we will be talking through. Let's quickly stand still on example one. This is, I guess, the most relevant example. The other two examples are really only trying to explain if you're smaller and what happens when I say the min-maxes play out in the logic. Example one is important to drive the chains home. So realistically, let's say you have an assessed loss or IFRS DTA of 3 million. And this year we've made profit, and the profit or the taxation on those profits end up being 2 million. So in the past, you would have been able to offset that 2 million. In other words, don't pay SARS 2 million, but my deferred tax asset will go from 3 million to 1 million, and I have a net position of 1 million still on balance sheet, right? However, the new amendment is basically saying we will in all cases always need to pay SARS at least 20% tax if we are profitable. So in other words, instead of just saying the full 2 million, it's 80% of your taxable income, which is 1.6, and you'll only be able to utilize, in other words, not a 2 million, but the 1.6 value against your deferred tax asset. And you end up remaining with a 1.4 and not a 1 million on balance sheet deferred tax asset. So this is a very important example. For purpose of time, I'm not going to jump into the other examples, but as you guys can see quickly, this is just playing the same scenario out, but with a little bit of a lower starting position, and then showing that the 80% of your taxationable income is still higher than your starting DTA, so you can just utilize a full DTA. And this scenario is really just showing the mechanics of which one is biting if it's low, or the higher of the million or your profits on that side. So to quickly summarize on the next slide, please. In general, I think the initial impact assessment for non-life or your average non-life insurer would be in South Africa is that there's actually various ways, and depending on where you are at on your IFRS on-balance sheet position, the profits you are making, this taxation change can impact your company in various ways. We've tried to generalize this concept for an average non-life insurer in South Africa. And in our view, this is how it will play out. So in terms of if you are loss-making and you're raising deferred tax assets, we are of the view that there's no impact. So in other words, there wasn't any changes in the taxation rates or on your kind of assuming IFRS 4, no changes in whatever you are disclosing as your loss, right? So your deferred tax asset, if you are making a loss, will be the same loss multiplied by your corporate taxation rate, giving rise to a DTA. However, in the instance where you have a DTA and are starting to make profits, that example one illustrated that you'll be utilizing your on-balance sheet deferred tax assets slower. And maybe just a very theoretical point is the fact that if you are persistently making high losses and you are then, or you have a higher DTA, that theoretically your DTA can creep up, right? And if we remember example 2 that we've discussed earlier, that if you have higher DTAs, your LACDT benefit in SAM tends to be lower, right? So that's just a very theoretical point that the creeping up due to the slower utilization might play in some way, shape or form out on your LACDT. But I think it's also worthwhile noting that you won't be running an insurance company in South Africa if you have persistently high losses, right? So that is just a caveat there. And then maybe to the next slide, please. The most important consideration of this taxation impact or change is summarized on this slide. And I think we really need to stand still, especially on the yellow item highlighted on the screen. So just to quickly think back, you'll remember item number 10 on the illustrative examples. Item number 10 and 11 was basically the ensuing 3-year profit projection. So in other words, checking your utilization, right? And in all 3 of our scenarios, the utilization, the utilization calculation was the minimum, which is the component that quote unquote bite. So what this taxation change now would mean, broadly speaking, when a typical capital actuary does the profit projections post a 1 in 200 year stress, for each of your 3 years post your 1 in 200 year stress, if you make profits, you will need to take into account that you will need to pay at least 20% to SARS, right? So that broadly means you need to pay 20% each year if you make profits in each of your 3-year projections. And hence, if your component that caps your LACDT is your ensuing profit projection, your profit projection will directly be 20% lower. In other words, directly impacting your benefit on your SCR by 20%. Vice versa, and that's kind of where these equations are coming in. If it's not your ensuing profit projections, in these profit projections, you will do the 20% logic or the taxation that's payable to such, but this is not a component biting. So in our scenario, it's not the 2.5, but let's say, for example, your DTA was only 2. This is the component biting. This change or taxation change will have no impact on your LACDT. So next slide, please. So I think it's very worthwhile to conclude on this taxation changes that it's important for us as capital actuaries to really monitor in your standard formula to what component is driving and biting on your LACDT. If it's your ensuing profit projection, then you will have a direct impact. And also worthwhile noting that your projections in your profit projection need to take time into consideration of when this is actually active, right? Vice versa, if it's your DTA component that's biting, then it's worthwhile to track if there's any scenarios in which it might actually be your ensuing profit projection that will bite, because then you would potentially also take a further 20% hit. But that's just a conclusion over there in terms of what the actual taxation change results in a SAM world. I think just to conclude further on some of the other aspects that we've spoken about, we've unpacked very vanilla examples of taxation, both in the IFRS world and how that plays out in your SAM and basis shift world. Maybe a final final closing comments is, and just to really drive this home from a practicality point of view, the calculations is exponentially more complex in reality. So I guess the question is why, and give some examples, right? So for example, our life colleagues can tell us that there's 4 tax sources or tax funds in life. And there's various rules that applies to these tax funds. So that's the first one where LACDT in a life world also is really complicated. There's also kind of different tax duration buckets and sources of taxation. So that speaks to the first bullet point. You have capital gain tax and you have like your corporate income tax, right? So if you think about your SCR calculation, the components broadly speaking being market risk, non-life risk, operational risk, some of those components, your non-life and operational risk broadly speaks to corporate taxation. But then in the market risk calculation, if you have an equity book, you need to kind of keep track of your capital gain. So typically that SCR shock in my example of 10 million, you will need to decompose that into your different SCR buckets, apply your various taxation rates, and then get kind of like a view of what's the DTA that you can realize. Then I think I've iterated this component, and it is very important throughout the presentation, is in your post 1 in 200 year stress scenarios, there's a lot of subjectivities and complexities involved there as well. Maybe to give a couple of examples, I mean, if you've had a 1 in 200 year event, it's almost like you need to go through a quick ORSA scenario or thinking process where you need to ask yourself, okay, listen, what management actions can we do? What is the typical view of our book and the loss ratios going forward? How will our investment portfolios, the equity book, look after 1 in 200 year event? All of these are decisions you need to make and also justify in some sort of documentation. So once again, just kind of stating that component. Deloitte's note really speak to the second last component. Over and above all of these other complexities, there is different interpretations. The FSI is open for interpretation. So there's different interpretations as well of the LACDT. Yeah, and I think that basically concludes it. The next slide is basically a thank you and any questions, guys.
Two questions here. One thing. Interested in examples where the basis changes from IFRS to best estimate, SAM, in brackets, leads to a loss, and what drivers are they?
Okay, so for an example, it might be the way you treat your reinsurance commission. So worst case scenario, your finance team has a fixed way in how they book this commission on some sort of assumptions. But in reality, if your market and your current operating environment is really negative, then on a best estimate basis, you might find yourself in a point of view where your sliding commission or some sort of commission will be, or you receive less sliding commission. And then when you do your basis shift, your income and asset sense will be a little bit lower, which can result in a potential loss from an IFRS to SAM.
And I'm going to quote Ashley here. Might be a silly question or not. The appropriate platform to ask. But what was the reason behind the tax change to increase tax income, since the netting off won't be done 100%?
Now, listen, I could speculate. I honestly, I guess it's a function of, the way the finance ministers and his team decide ultimately they want to drive taxation rules and laws. The implication for insurers is basically the component where it broadly speaks to the fact that you need to make or pay at least 20% profits to SARS if you start to become profitable again. And I guess that broadly speaks to more income for the government to do other aspects. So it's probably a budget question on their side where they can generate some additional funds. And that basically is the way it played out in our environment.
Thanks, Robert. Just two more online questions. One from Alexis.
Can you list the specific parts or elements of the SCR calculation in which LACDT and the concept of income taxation are primarily included or taken into account? Can you list which parts of the SCR calculation do you take into account LACDT or income taxation into account?
Okay, I'm going to answer this question kind of twofold. The ultimate benefit of your LACDT is kind of taken at the end. So on a diversified level, BSCR plus your op risk plus your participations, and then it's a straight sum of your LACDT benefit. In terms of determining that benefit, you need to, as I've mentioned, decompose. Well, there's various, and that's where the ASA guidance note comes in, right? Depending on your complexities in how detailed you want to do that calculation. But broadly speaking, you will need to unpack your SCR, as I've discussed, into its various components, being market risk, non-life, op risk. And these charges, which is basically your loss, will attract different taxation rates. And sometimes insurers use a weighted average. They sometimes do it more granular to use, for example, capital gain tax directly on equities, and from an income statement point of view on your profit projections if you have realized or unrealized gains. So hopefully that makes sense. Just to quickly conclude, the benefit is on a diversified level, but in determining that benefit, you really need to start unpacking the components and applying the, let's call it the equivalent taxation rates, to those components.
And the last online question, is there a maximum period over which the tax asset can be spread? The illustrative example mentioned a rollover to other years.
So I think it's 3 years, right? Yeah, so
3 years.
it's 3 years. And therefore, maybe just to also build on that question, the importance of that recoverability calc and your horizon on that calculation is also 3 years. Okay, thank you so much, guys.
Thanks for that, Walt. We're on to our final topic of today, and that's going to be the impact of rising rates and impact on the short-term insurance market. Speaking on this, we have Ron Richman. Ron Richman is the Old Mutual Chief Actuary. He's a qualified actuary with ASA and the IFRS, with a full ASA Africa practicing certificate in short-term insurance. He has worked with a number of South African insurers, a cell captive insurer, and a specialized credit insurer. His areas of experience include reserving, capital modeling, quantitative risk management, pricing and product development, and statutory review. Let's give a round of applause for Ronald.
There we go. Okay, so I just wanted to give one quick word of background. How did we choose these 3 topics? So we've had IFRS 17, we've had changes to the Tax Act, and now we're going to talk about rising rates. What the aim of these sessions is really to get more actuaries qualifying in short term. And when we Okay. Yeah, we're back online. Okay, cool. Back. Okay, so the third one is going to be what's happened in the past couple of months with rates. So interest rates have really gone hockey stick shaped in the past couple of months, and we're just going to have a quick look at that and the implication for short-term insurers when we're looking at the slide. So if we go to the next one, just to set the scene a little bit about fixed income and rates in South Africa and what have interest rates been doing. Thinking about the asset side of your insurance balance sheet, the liability side, and then implications on a bunch of different actuarial processes. So if we head to the next slide, you often are given interest rates when you're doing actuarial work, particularly in short term. But it's quite interesting just to think about what are a couple of the other sources of interest rate data in South Africa. So if you're doing a SAM valuation, like we've been speaking about, often you can just use the Prudential Authority yield curve. They publish that every month on the website, and all of the data that I'm going to be showing in this deck is from the PA yield curve. There's also other yield curves that you can buy. So there's a daily yield curve published by the JSE. If you're ever doing asset valuation, you might have a reason to subscribe to that. There's the Bloomberg Terminal, which gives you a South African government bond yield curve. And then the SARB, I think daily or monthly, publishes the short rate, which is effectively what banks can borrow on overnight in the fixed income market. So those are the different sources of interest rate data in the South African market. There's some information on the different types of curve. So if you ever are given an interest rate curve, you should always ask yourself, is this a government curve, which is derived from interest rates based on government bonds, or is this a swap curve? Because what you can also do if you want to trade interest rates or trade interest rate risk is you can take out a swap with the bank, and the rates at which those banks price those swaps, that's available in the swap curve. Another good question to ask is, are you looking at a nominal curve or a real curve? So a nominal curve is basically including inflation, and a real curve strips out the impact of inflation to say, and the way that you derive those curves is generally from a different set of bonds. It's from a set of inflation-linked bonds. You can sometimes have curves that are risk-free as opposed to curves that include risk premium. So we've been talking a lot about the difference between SAM and IFRS 17. One of the main differences in terms of yield curves is under SAM, you have to use a risk-free curve where you've stripped out credit premia and illiquidity premia. Credit premia is if you buy a risky bond and someone might default, obviously you'll demand a higher rate. Liquidity premia is if you can't get your money out quickly, you'll also demand a higher rate. Whereas under IFRS 17, you're actually allowed to leave in your liquidity risk premium. If anybody knows how to calculate that, I'd love to hear what the industry is doing. And then another very important thing is forwards versus spots. If you're talking about interest rates in a year, there's two things you could be talking about. One is what is the interest rate we'll earn from now all the way to a year. Another one could be what is the interest rate that you will be able to lock in now if you invest in 1 year's time, and that's a forward. So these are just some of the common pitfalls whenever you have interest rates and what the Prudential Authority gives you. So remember we said you can get Prudential Authority yield curves for SAM. What they give you is a government curve that is nominal, and they also give you a real one. They give you a risk-free rate, and they give you forward. What you have to do for actuarial valuation is turn those forwards into spots. So I'm not going to go into that right now, but basically just something to watch out for. Don't use the raw PA curve. And then also, very interestingly, what we said the difference between a nominal curve and a real curve is a nominal curve includes inflation. A real curve says, what is the return you get net of inflation? You divide your nominal curve by your real curve, you get some estimate of inflation. Okay, so that's a little bit of background. If we head to the next slide, thanks so much. What I've shown over here is these are the Prudential Authority curves. This is going all the way from when they first started publishing these in 2015 all the way up to the end of April last month. And the different colors represent different parts of the curve. So on an interest rate curve, you'll have a rate which tells you what will you earn now all the way up to a quarter of a year, half of a year, 3/4 of a year, 1 year, and that goes all the way up to 50 years, if I remember the PA curve correctly. And what I'm doing is I'm just plotting these rates at these different terms over time. What you can see basically is COVID happened around here, so everything was going well. Rates were about 6.5. The yield curve was nice and flat, and then COVID happened. The economy shut down. Central banks panicked, and they said we better cut rates to stimulate the economy, and that was great. You could buy things really cheaply on credit, and ever since about August of 2020, rates have been coming back up again, and we almost at a high point on the PA yield curves for these yields. So this is basically the environment we find ourselves in, that interest rates have gone from almost an historic low up to what's almost a historic high. If we actually look at the yield curves themselves on the next slide, what we're plotting over here, these are the yield curves at the end of April for every year since 2015. So there's 2015 and going all the way up to 2023. And basically, just a couple of the characteristics you can observe is these yield curves were nice and flat. And then what happened in 2020 is things got really, really steep. You can see it goes all the way from about 4% all the way up to 15%. We weren't anywhere near 15% up there. And in the last couple of years, we're going to focus on this in the next slide, again, to show what are the changes in the environment been. Thank you. These are the curves for at the last 3 April. So 1 month ago, 13 months ago, and 25 months ago. Hope I got that right. And basically what you can see is this was the curve during 2021, very steep. Not really all that much happened. Rates started going up in 2022. And then we realized, wow, we're getting really hit badly by inflation, and things went up by almost 4 or 5%. You can see over here. And this is the situation we find ourselves in. So we've had this massive jump, but almost all terms up to 5 years. And currently, if we take the most recent curve, we're almost at an all-time high on the long end of the curve. So what really the rest of the presentation is going to be about is, so what do we do about this as short-term insurance? What are some of the implications? So if we head to the next slide, please. What we've got is just why did the central banks get us into this mess, right? So I've tried to derive inflation by dividing your nominal yield curve by your real yield curve at 2 points in time. So I've done this at April last month and April a year ago. What you can see is actually the longer term inflation expectations are going up. So that's the upward slope that you see. In fact, longer term inflation expectations have come down a little bit year on year, but it's this bump that central banks are targeting. In other words, inflation expectations, inflation has been quite high recently, and expectations baked into the market curve that it's going to get even worse. And that's why rates have been rising, if you remember some of your economics, to try to counter that effect. Okay, so if we head to the next slide. What I want to just show on this slide is, if you're ever given a question in an actuarial exam or even in real life, it's just what do you do to measure interest rate risk? And the thing to remember is, unless you're doing derivatives trading, you're not going to be worried about the rates themselves. What you're going to be worried about is, how do the cash flows that you have in your company relate to interest rates? So what I've got, I've just made up a simple liability profile and asset profile. So imagine that your investments as an insurance company are going to yield 25 million rand a month, and that's going to carry on for almost a year. And so these will be cash flows that you get coming in, right? What your liabilities look like, this is very typical of a short-term insurer, is we've got a big payment due next month, a much smaller payment, and then that kind of decreases exponentially. And unless you're writing really long-tail lines of business, a long-tail line of business is something where the claims take a very long time to get paid out, you're going to see a liability profile that goes quite quickly like that. So if you look at discounted values, again, using the same yield curves last month and April in 2022, in this case, using the 2023 yield curve, your discounted value of your asset cash flows is 309.6 million. The discounted value of your liabilities is 197 million rand. What happened by moving the yield curve is your value of your assets has gone, sorry, If you started at 2022, it would have been 314 million. Your liabilities would have been 198. By moving to the higher yield curve, your value of your assets has gone down and the value of your liabilities have gone down, but the value of your assets has gone down by more than your liabilities. And this is exactly what interest rate risk is, that you might have a change in your yield curve. Suddenly you've got a 4 million rand loss, and generally shareholders and excos and the market really doesn't like when you have these sorts of losses, because they don't invest in insurance companies for interest rate risk, they invest in it for making profit from investment policies. So how can you actually measure your interest rate risk? The crude measure that you often learn about in CP1, or what's it called these days? A101, I can't remember. Anyway, is you look at what's your average time to payment of your assets and liabilities. So what you can see is your average time to payment on your assets is 0.58, on your liabilities is 0.166. That means your assets on average are paid out longer than your liabilities. That's been called long interest rate risk, and that means if your curve moves up, you're going to lose money. A better way of doing this is looking at dollar duration and modified duration. What these basically tell you is for 1% change in the yield curve, how much money do you stand to lose in each position, and what percentage of your position do you stand to lose if the yield changes by 1%. So basically, over here, you stand to lose 0.5% of your asset portfolio, but you stand to make 0.2% of your liability portfolio, and that gap is exactly what you need to manage if you're worried about rising rates. Okay, so that's interest rate risk measurement in as quick a way as I could do it. Okay, so now let's think about some of the implications on your asset portfolio. What a lot of short-term insurers are invested in generally in the market is quite simple assets. So you might have some bonds, you might have some cash in the bank, you might have some money markets, and only very rarely will you have insurers who invested in equities or derivatives or anything more exotic than that. The key thing to think about is what part of your balance sheet can get hurt by changes in interest rates is only those assets that are actually sensitive to interest rates. So how do you know if some assets are sensitive to interest rates? What you need to again look at is your accounting standard. So on the asset side, different ways of looking at assets are you could hold bonds that amortize book value. And I'm sure you might have heard of the recent bank collapse from Silicon Valley Bank in the States. And one of the reasons they're giving for that is the American banking regulatory regime allows you to hold bonds at book value. If you buy a bond for $95 and interest rates have gone up dramatically like they have, and now your bonds can only be sold for $90, you've got a $5 gap on your balance sheet. And when depositors in Silicon Valley Bank realized that's exactly what had happened, they pulled their money out, and that's the beginning of the Silicon Valley Bank run. Another way of doing it is mark to market. So that basically says if you're holding bonds, look at what the value of the bond actually is on the JSE and update your accounts accordingly. And then mark to model is basically a different concept, which is if you can't work out what this bond is actually worth in the market, you can come up with a model which can value that for you. So in South Africa, both IFRS and SAM usually use market values for traditional bonds, treasury bills, and commercial paper. But there might be some bonds or other assets. So for example, a property will generally be at some sort of market valuation that's only updated every year. You also do get bonds that aren't sensitive to interest rates, the rate that we're talking about. One example of that is inflation-linked bonds. That's where your bond cash flows depend on inflation. So changes in your nominal yield curve don't affect it. And another one is what's called floating rate notes. And these are called floaters. This is where the value of what you get out of the bond depends on the interest rate. So I'm sure you can understand from that if your interest rates go up by 5%, you're going to get 5% more cash out of this bond. And that means there's no interest rate risk. But what a lot of people do in a situation of rising interest rates is actually change your investment profile to focus on these types of instruments. And if you're expecting interest rates to come down and the value of interest rate sensitive assets to go up, you buy these sorts of instruments. There's really only a second order effect on other mark-to-market assets like equities, swaps, equities, credit spreads and options. But the key opportunity to think about in a rising interest rate environment for an insurer is, hey, let's go earn some higher returns on the asset part of your balance sheet and offset some of the damaging effects of inflation that most insurers are experiencing. So that's the asset side. Let's think about the liability side. Thanks so much. Okay, so on the liability side, again, you're changing your yield curve or you're changing your rates only affect those liabilities that are interest rate sensitive. And this is, again, really important in terms of which accounting regime you're under. So let's think about the two types of insurance liabilities on your balance sheet. One type is retrospective. So if you have written a whole bunch of motor policies on your book, you might have been informed about some claims, and that will be your OCR, your outstanding claims reserves. For some reason, some actuaries like to call it RBNF sometimes, and that's just a red herring because no one actually calls it that in practice that I've ever met. And then you also have incurred but not reported claims. So someone's had a car accident, they haven't gotten around to filling in their paperwork, so your actuaries are going to calculate those reserves. That's retrospective. And these components is basically what Walt and Karen were referring to in terms of your technical provisions under SAM or your liability for incurred claims under IFRS 17. Your prospective reserve for the future depends very much on your accounting standard. Under IFRS 4, it's called unearned premium reserves. Under SAM, it's premium provisions. And under IFRS 17, I've somehow left out liability for remaining coverage for prospective. So what happens in terms of interest rate sensitivities depends on your accounting standard. Most insurers didn't do any discounting under IFRS 4, so you never actually had to worry about interest rate sensitivities on your asset portfolio, on your liability portfolio. And what that meant is no one ever bothered really thinking about ALM as a short-term insurer on IFRS 4. Under IFRS 17, you discount your retrospective reserves generally, but you don't do your PAA, which is your prospective reserves. So you are now somewhat exposed to interest rate risk. And then finally, under SAM, you discount all your liabilities. So what this means is under IFRS 17, this big shift that we're talking about, and like Karen mentioned, all of a sudden you need to start thinking about asset liability management. Okay, so let's look at some impacts of this on some of your actuarial processes. But the main thing to take away from the asset and the liability section we've just discussed is your risk is really depends on your accounting regime and whether the accounting regime says you need to discount or mark to market or not. So that's probably the key principle in a nutshell. So what can happen in terms of pricing? We've got our head of pricing here, so if I say anything silly, please correct me. So short-term pricing generally doesn't account for investment income. So when you're going to do short-term pricing, you'll look at some of your claims experience. So this is what I've got to charge and go ahead and charge it. You're not going to say, wow, we're only going to pay these claims in 6 months' time and we're earning 10% a year, so you can discount that. Generally, I've never seen that happen in short-term pricing. Am I right, Club? Maybe. Okay, good. But for long-tail business, one book of business that Mutual and Federal Risk Financing now writes is medical malpractice. And those payments you're only expecting like 10 or 15 years. So if you're pricing that, it would make a lot of sense to at least allow a little bit for the discounting because you're going to earn a lot of investment returns on those premiums. So this implies that for most short-term insurers, your premiums don't assume investment income. And any investment income you get is just a bonus on top of your underwriting profit. And that's how a lot of insurers have treated it. As I've said, most of the market, or the way we like to think about the market, is people are investing for your insurance underwriting and not so much for your investment capabilities. But in the current environment, like we said, inflation has gone up, and that's why rates have risen. And inflation means our claim costs are going up, right? So accounting for the fact that you're going to get a little bit of a boost from your investment income starts to become quite important. And I know a lot of insurers now are thinking very hard about their asset strategy to see what we can do to try offset some of the inflation. So really the net effect on profitability depends, in my mind, on how pricing is updated for inflation. If you're suddenly responding very strongly in your pricing, and you can get away with that in the market, if it's not a particularly competitive line, then you'll probably just have this bonus on top of your underwriting profit. Okay, let's think about reserving now on the next slide. So this one is very interesting. So like we said, the liability side of your balance sheet is now discounted under IFRS 17 generally, and has always been discounted under SAM. So if we think through the impact of changes in rates, the first thing to think about is what is the term of your liability? So most short-term lines of business are short tail. So what that means is you're going to pay your payments out pretty quickly. And that means that there's relatively smaller impact of higher rates. But for your much longer term liabilities, like we said, maybe arising out of a long tail liability book, there can be huge impacts of higher rates. You need to be very aware in your reserving of what type of liabilities you're trying to reserve for, and just anticipate what those impacts could be. Also, for longer tail liabilities, you need to be much more worried about asset liability matching. Because if your yield curve suddenly shifts back down, suddenly you've got a much bigger increase in your liabilities, but that won't be the case if you've only got short tail liabilities on your book. The term of your cash flow projections also depends on the type of reserve. So if you're projecting out in the future to say, hey, I'm only going to have claims payments in a year, and it will might take a year after that to get paid, that's going to mean your prospective reserves are much longer term than your retrospective reserves. And this leads to a much bigger impact on SAM, because you need to both discount your retrospective and prospective reserve, whereas under IFRS 17, you're not actually discounting any prospective reserve. You're only discounting retrospective reserves, which is your LRC. Something to think about those under IFRS 17, you can set your own yield curve to some extent or another, so you can moderate some of these impacts, and you can add back a liquidity premium. But maybe a key takeaway under IFRS 17 is if you're setting your own yield curve and you're anticipating some investment income, then make sure that you're actually earning that in your investment portfolio, else you're going to have a loss at the end of the year. And again, stock market doesn't like that very much. Okay, now some miscellaneous ones. Thanks so much. So one miscellaneous thing to think about is economic capital, which is your own view of how much capital you need to hold to run your company. So your capital more or less depends on how uncertain you are about a particular situation. So if there have been very significant moves in interest rates, this means you might not actually understand the interest rate market as well as you once thought. So you might need to update some of your parameters for interest rate risk. But the biggest impact for short-term insurance is not so much the change in interest rates, but what's driving it, which is the change in inflation. So if you have an economic capital model, you really should be thinking about increased inflation uncertainty, and as a result of that, maybe needing to hold more capital on insurance risk. Another very key area is investments. So often, in fact, always you have some actuary who has to talk about asset liability matching within a short-term insurer. And some actuaries are also more closely involved with investments. In this case of rates going much higher than they've traditionally been, I think we've been trying to emphasize you really need to think about your asset liability matching. But with the move to IFRS 17, increased asset liability matching risk can now affect your profit and loss statement on financial reporting. So again, like we said, you need to start managing that on a SAM basis. And really what the opportunity is and where actuaries can demonstrate some value add is thinking about the composition of the investment portfolio and how you can earn better yields. And then one last slide to end off. Thanks so much. So another area that might affect is your own risk analysis. So if you are raising capital in SAM, what your SAM capital basically did was an analysis of yield curves up to 2011 or 2012. And they basically derived volatility factors from the yield curve experience that they had up to that date. But like we saw in the previous slides, we've had these absolutely massive shifts in yield curve. So what this analysis is something that might be useful for another process that actuaries do, which is an own risk analysis. You have to perform this at least once a year, called an ORSA. It's a big report that you have to write and get your board to sign off. And one thing you could do for your ORSA is say, well, SAM says your 1 in 200-year risk on interest rate risk is maybe 100% move of your yield curve. So let's say your yield curve was 5%, you need to recalculate your liabilities as if that had gone up by 100% to 10%. So what I've done over here is I've taken all those yield curves and done the same analysis they did for SAM. And what you can see is something very interesting, that for up to 20 years on the yield curve, your stress at a 1 in 200 year level is about 90%. In other words, if you're running at 5% on your yield curve, you need to now recalculate at a 9% yield curve, which is 90% of 5%. But what happens after year 20, you've had massive instability in the yield curves, and you might need to even hold 200% capital. And no one's actually bothered recalibrating this in the South African environment that I'm aware of. So this is a very big risk if you are a big life insurer and you have been doing this sort of analysis. So that's basically the story. So we try to look at what is the interest rate environment in South Africa, what sort of data is there, what has the experience been, what's the impact according to accounting standards, and then what are some specific points to take into account in actuarial processes. I think that's the last slide. Is that it? Thank you so much. Any questions?
Thank you, Ron. Always informative. We've got 2 online questions, and the audience here can also ask questions. The first one from Ashley: why are rising interest rates not curbing rising inflation rates? So why is this rising of interest rates actually not working?
Yeah, so I'm not an economist, but what I think people are saying is it's not necessarily just driven by factors that interest rates can counter. So in other words, raising interest rates in the South African economy is not going to help if you've got big demand shortages on things that we import, and there's actually just not enough supply. Prices are going to go higher. There's also been a very big shock through the Ukraine war in energy markets. So energy prices have gone up. And yeah, so interest rates are just a bit of a blunt tool. And I don't think they're able to directly target the drivers of inflation in the country. And then the other very important thing to remember is just this is a short-term insurance event. Your drivers of inflation in a short-term insurance might be different from the drivers that your central bank is targeting. So even if things are looking perfectly fine in 6 months in South Africa from an inflation perspective, doesn't necessarily mean that the superimposed inflation that you have in a short-term insurance environment is actually going to get any better, which is another risk that you run.
Thank you, Ron. The next one, again from Ashley, thank you. What happens to the PA yield curve used in SAM if inflation increases with no resultant increase in interest rates? So what would happen to the yield curve if inflation increases but there's no increase in interest rates?
So it's an interesting question. The way I interpret that is saying, what happens if the central bank doesn't raise rates, but your inflation is nonetheless going up? What will generally happen in that case is the market will think about what is the central bank likely to do in the future. So if they're not raising rates, but the expectation is they're just taking a bit of a break, but you'll have a massive rate increase in, say, a year, you'll just have a very upward sloping yield curve. You take into account the fact that the expectation is they will have to do something. Let's say your yield curve doesn't move. What will happen is your difference between your nominal curve and your real curve will widen. Or what that basically says is if inflation is out of control, it's just going to erode all of your nominal rates, and that will mean that your real returns will actually be negative. So in a lot of countries after the 2008 financial crisis, you actually had negative real rates at most parts of the yield curve. And you could also see this in South Africa a couple of years ago. So that's my guess.
Thank you. Interesting. Educated guess. The next one is from Vuyilek, and can we go to slide 48? It says, please clarify whether it is LRC or LIC that is considered as retrospective reserves and hence discounted or undiscounted.
Sure. So under IFRS 17, it will be your LIC, which are your retrospective reserves that are discounted. Remember your PAA, like Karen very eloquently showed us, is just UPR, with a bunch of cash flow considerations mixed in. But the UPR component is not discounted, it's not cash flows. And that means that, yeah, under IFRS 17, unless you're adopting the GMM, which very few short-term insurers are doing, you only ever will be discounting your retrospective reserves. and that you don't even have to discount those if they are under a year in terms of terms. But most insurers will probably be discounting their short-term reserves. Sorry, their retrospective reserve.
Oh, you're gonna like the next one. Would the rising interest rates render the 6% cost of capital rate used for SAM risk margin too low?
I would say no, because the 6% cost of capital rate is meant to be calibrated as the premium over and above risk-free. So I don't think it needs to change because of rising rates. That's the margin over and above risk-free. The real question is 6% appropriate in South Africa, and has it ever been? And I don't know if that's been answered adequately yet.
Thank you, Ron. Any questions from the floor?
No, that's it. Thank you.
Okay, and that brings us to the end of our presentation. I would just like to thank everyone that was able to join us here in person and everyone that joined virtually. I'd like to thank each of the speakers to going through those topics and giving us a bit of insight as to how to treat those topics in the upcoming exams. I wanted to thank the IT team and the people behind the scenes that were able to make this possible. So big shout out to you guys. That's essentially it. That's all the thank yous. For everyone who's about to write the exams, the short-term insurance exams coming up, good luck to the examiners taking it. And then lastly, for everyone here in person, we'd like to invite you for drinks and some networking. So please feel free to stay and chat with us afterwards. And one more thank you that I forgot, obviously. Thank you to Old Mutual Insure for this fantastic venue and hosting us all tonight. So can we please give them a big round of applause? And that's it.